Mastering Forex Trading Psychology as an Intermediate Trader. Introduction. As an intermediate Forex trader, mastering trading psychology is essential to achieve consistent success in the dynamic and often challenging market. Trading psychology refers to the mental and emotional aspects that influence traders' decision-making, risk management, and overall performance. In this text, we will explore key psychological factors that intermediate traders need to master to become more disciplined, resilient, and emotionally intelligent in their trading journey. Embrace emotional intelligence. Emotional intelligence is the ability to recognize, understand, and manage emotions effectively. As an intermediate trader, it is crucial to develop emotional intelligence to control the impact of emotions on trading decisions. By identifying emotional triggers such as fear, greed, or overconfidence, traders can make rational choices and avoid impulsive actions. Maintain discipline. Discipline is a fundamental aspect of successful trading psychology. Intermediate traders should stick to their trading plan, risk management rules, and predefined entry and exit points. Following a disciplined approach helps avoid emotional decision-making and ensures consistency in trading performance. Cultivate patience. Patience is a virtue in Forex trading. Intermediate traders should understand that not every opportunity will lead to a profitable trade, and the market can be unpredictable. Cultivating patience allows traders to wait for high-probability setups and avoid making rushed decisions out of excitement or fear. Learn from mistakes. Trading psychology involves embracing mistakes as valuable learning experiences. Intermediate traders should view losses as opportunities to analyze their decisions, identify weaknesses, and make improvements. By adopting a growth mindset, traders can turn setbacks into stepping stones toward becoming better traders. Manage fear and greed. Fear and greed are powerful emotions that can lead to poor trading decisions. Intermediate traders should be aware of these emotions and work on managing them effectively. Implementing risk management techniques such as setting stop-loss orders and adhering to position sizing rules can help control fear. Rational profit-taking and sticking to the trading plan can mitigate the influence of greed. Avoid revenge trading. Revenge trading occurs when traders try to recoup losses immediately after a losing trade. This emotional response can lead to impulsive actions and further losses. Intermediate traders must recognize revenge trading tendencies and take a break to regain composure before re-entering the market. Focus on process over outcome. A successful trading mindset prioritizes the trading process over the outcome of individual trades. Intermediate traders should assess their performance based on how well they executed their trading plan and followed their strategy, rather than solely on profits or losses. By focusing on the process, traders maintain a long-term perspective and reduce emotional reactions to short-term fluctuations. Deal with trading stress. Forex trading can be stressful, especially during volatile market conditions. Intermediate traders must find effective ways to cope with stress, such as taking regular breaks, engaging in relaxation techniques, or maintaining a healthy work-life balance. Managing stress helps traders maintain mental sharpness and decision-making capabilities. Avoid overtrading. Overtrading is a common pitfall for intermediate traders. It occurs when traders take too many positions, leading to increased transaction costs and higher risk exposure. Intermediate traders should wait for high-probability setups and avoid the temptation to trade excessively. Set realistic goals. Setting realistic trading goals is essential for managing expectations and maintaining a positive trading psychology. Intermediate traders should avoid setting unrealistic profit targets and understand that consistent profitability takes time and effort. Setting achievable goals allows traders to measure progress and celebrate accomplishments. Conclusion. Mastering Forex trading psychology is a vital aspect of becoming a successful intermediate trader. By embracing emotional intelligence, maintaining discipline, cultivating patience, learning from mistakes, managing fear and greed, avoiding revenge trading and overtrading, focusing on the process over outcome, dealing with trading stress, and setting realistic goals, traders can enhance their mental attitude and achieve consistent success in the Forex market. Developing a strong trading psychology complements technical and fundamental analysis skills, making it an indispensable component of a well-rounded and profitable trading approach.